Good morning, everybody. It's Good Friday, and I hope everybody's having a fantastic weekend. It is a 3-day weekend. The stock market is closed today, and we'll resume business as normal on Monday morning. The week was a tough week. There's no other way to put it. Microsoft was down 7.1, Google 6.7, Tesla 6.8. Those are the stocks we love, the stocks we look at all the time. Amazon was down 3.8, Apple was down 3.98, and the big loser of the week, Nvidia, down 12.19%. Financials were kicking off the beginning of the earnings season, and JP Morgan, Jamie Dimon, gave a gloom and doom outlook for the year, and it didn't give the market any confidence, and we ended up going sideways for the rest of the week and a little low. You could see that XLE, the energy sector, was the leading sector again for the week. Surprisingly, retail was number 2, and it really was surprising to me because consumer discretionary, XLY, was number 3, and at the bottom of the list we have SMH, which is the semiconductors, and XLX, which is technology. SPY, the S&P 500, was close to the bottom of this. There was a lot of sectors that outperformed the stock market, but with technology being as heavily weighted in the S&P as it is, it did drag the market down. I don't want to get into economic data to Trump, Jamie Dimon. I think Jamie Dimon's wrong. The economic indicators are pointing toward expansion, not contraction. I don't think our economy is weak. I think it's strong, but we'll cover that on a different day. One thing I do want to cover is the bull-bear sentiment from the AAI, American Association of Individual Investors survey. We are now at 15.8% of investors feel like they are bullish. 15.8% feel like the market, this is a good time to buy stocks. 48.4% are bearish and 35.7% are neutral. The last time there was this many bears in the market was the bottom of 2020. Now, I'm not saying that this indicator is calling the bottom. I'm just saying this is a lot of bears. This is a lot more bears that are normally in the market. So something that can happen when there's a lot of bears is it can either turn the market around or it can intensify a sell-off. So we're going to cover those scenarios, and they put you guys in a situation where you're prepared for either scenario. For the week, we went sideways. We began the week and we closed the week in the same general channel between 445 and 437. It's a small range. It's about a 2% range, and it really was difficult to hold anything overnight because we knew that the range was just going sideways. I was expecting island reversal pattern to play out, and it didn't play out, but it's still holding, so that's part of your bull case right there. Your fib retracements, it held at 38.2 line, and if it holds on that 38.2 line and bounces up, you could see that we're forming a new uptrending channel, and right now we're at the bottom of the channel, which is the place where you want to buy. If you got ahead, I think you're doing good, but there's a possibility that we're going to go lower. We just had a 50-50 sell signal in the market. A 50-50 sell signal is when the price action goes below the 50-day moving average and the RSI drops below 50. It's one of those sell signals that when it happens, it tends to intensify a sell-off. Now, part of the bull case that we have going on is we know that this big green candle on the SPY had a lot of institutional buyers. That big green candle on the weekly is represented right here by these 5 candles. And we know that there was a lot of institutional buyers there. They're not selling off the market right here. Institutional buyers are not selling off the market. So this 38.2 retracement level could be where the institutional buyers are defending their positions. And unless they want to take losses or short the market, there's a possibility of a hard reversal here and a continuation of this 1, 2, 3 pattern going towards the upside. The bear scenario is that these institutional buyers right here, if we drop below that 38.2% line, it's going to set off a lot of algorithmic sell signals. So the computers are going to start selling so that they don't end up going into negative positions for the year. Because they did buy right here. They did buy at the bottom. You could tell by the velocity of the buying. There was a lot of institutional buying. A drop below that sets off a lot of sell signals, and it could intensify some selling that'll drop us down to the 428 area or the 23.6 fib retracement level at 426.90. That's a possibility. The problem with that, if you're a long-term holder, is that sell-off is going to intensify, and it likely will not stop until we close that gap at 400. Now, I want to tell you guys, if your portfolio is down for the year, if you have long holdings, it's not likely that you're holding bad positions. The market is tough right now, and you are not alone in feeling like you're doing something wrong. Only 15% of people are bullish right now. I'm still a bull. I still think that the year is going to close around with SPY over 500. But that doesn't mean we're not going to have more downside between now and then. There is going to be a hard rally. It's going to rip a lot of people's faces off. And when that rally comes, if you're prepared, you're going to make a lot of money. If you're not prepared, you're going to buy in up here, and then you're going to get another sell-off. So one way to look at it is you could be a dip buyer right here. I think the risk-reward ratio is good. The triple Qs have shaped this really nice inverse head and shoulder. Really nice inverse head and shoulder. But that 38.2% retracement line is exactly where we need to be for that inverse head and shoulders to play out. If we drop below that 38.2% retracement line, then that inverse head and shoulders is out the window. The island reversal pattern is out the window, and it intensifies the sell-off and will likely make a new low for the year. There is one more line of defense for the triple Qs at the 23.6 retracement line at 330.43 for the triple Qs. That will be our last line of defense. Once that breaks, I do think we're making new lows for the year, because we already have a double bottom, and a drop below is just, it'll be ugly for the market. We also had a 50-50 sell signal for the triple Qs, and you could see how the sell-off intensified once we had that 50-50 sell signal. And where we closed for the week is exactly where we need to close in order for this inverse head and shoulder to play out. But a break below that will intensify the sell-off. One thing I wanted to show also, on the S&P 500, on the Discord, we talk a lot about the Fibonacci retrace. We talk a lot about the Ichimoku clouds. Currently on the daily, we're inside the Ichimoku cloud. And if we get to the bottom, which is support, it's at the 430 level. Once we get to that 430 level, what it also shapes an inverse head and shoulders for the SPY. And then a bounce off of that level, again, will take us in the direction of all-time highs. Buying the dip right now is a little early. Buying the dip right now is buying the dip, understanding there is more downside. But in my opinion, the risk to reward is good. I like the setup of buying right here and letting it go up. I didn't sell any positions at a loss last week, even though the market is looking like there could be more downside. But I'd rather be in the position when it turns around than be trying to catch the position up here. I hope this helps you find some entry points. I will make some stock specific videos over the weekend, and feel free to ask any questions on the Discord. Do us a favor And hit that like button, hit that subscribe button, and share it with your friends. And we will see you on the Haikhuu Discord.